guys. Thank you all for logging in and joining us today for what is the 2020 budget update. It's been an unprecedented year in economics space, or economically, and the stimulus that happened earlier in the year has been further extended in this budget, and we think we're pretty excited to bring it to you today. There's lots in it for really every business owner and every taxpayer. So on behalf of my fellow panellists, Leanne Merowitz and Josh Parsons and all of us at Shakes, we're really excited to bring you today's presentation. So without further ado, Andrew, over to you, mate.
I hope I'm here. Sorry about that, folks. Every now and again, technology is intriguing. As someone who does way too many of these presentations as a daily thing, it is quite disconcerting when you go to log into something and it's not there. But anyway, here we are. So what we're doing today is a budget overview. I've tried to sort it according to things that would be most relevant to you guys and hopefully to businesses generally. The budget's a massive document, and so there are a whole lot of directions that we could take it, but we focus mainly on some of the business stuff, some of the business lending aspects, and some of the concessions that the government has introduced. So I will get into it. I can see questions now. Thank you to Matthew for suggesting making me co-host, and I will wander through as best we can. I am going to start with a slightly unusual start, given that I said we focus on business. I just want to quickly run through the personal tax cuts that were announced. And the reason I'll do that is these have copped probably more press than almost anything else. And I'm not really sure that what the government's done in this area will make a massive deal of difference. But I just wanted to quickly run through what it is that the government has done. And for those of you that have tried to follow along and you're confused by some of the information that's out there, that's completely reasonable because the way they've announced it is a little bit confusing. So there was a lot of talk in the lead up to the budget about the government making these massive tax changes, which are these ones over here. The government started introducing these tax changes a couple of years ago, and they've done them in 3 stages, and they're all legislated. And there was talk of bringing this stage, which you can see is due to start July 22, and this stage, and bringing that all to now, sort of all back to now. They decided to leave the big tax cut, 32% tax bracket out from 37 to 45, and it moves the 32.5, and it moves the 37 from 90,000 out to 120. And overall, that makes very, very minimal or limited differences to most people. They have then left a thing called the low and middle income tax offset in for an extra year. That's all the personal tax cuts were. The net effect of that, I'll go to the net effect because that's easiest, is if you earn between 45 and 90 grand, you'll have an additional $1,080 of post-tax income for this year. And if you earn more than 120, you'll have an additional $2,500 of post-tax income. So for a lot of people, it's $1,000. For a few people, it's $2,500 grand. The other confusion in this area, and this may have come through for those of you that are employers, where the government, Josh Frydenberg, the Treasurer, was on television nationally on, I think, Sunday night, and he was talking about the way that they were going to deliver these tax cuts was via PAYG withholding, and they would modify the PAYG withholding tables. Now, obviously, these changes have been brought forward to 1 July 20, which is 4 months ago. So how do you change the tax tables from today to account for changes that started 4 months ago? So if we just look at this, I'll just try and explain it as simply as I can. Someone who's getting a $1,080 benefit, that's roughly $20 a week. Can you still hear me? Because I'm getting a message saying that my internet connection is unstable. No? All good? No, all good, guys? Yep.
Yeah, you're
Okay.
okay.
So, yep. Okay. So it's just going to be one of those technical mornings, I suspect. We just push on. So basically, we've got $20 a week increase over 12 months. But because we're already 4 months in, because we've gone from 1 July to October, what the government had suggested is they would squeeze those $20 a week into 8 months. So instead of getting $20 a week, you'll get $30 a week. And they announced that everywhere over the last few days. And then the ATO came back 2 days ago and said, we can't do that. They're just going to give you the $20 a week. And if you end up paying too much tax, you'll get a bigger refund at the end of the year. So as employers, those of you that are employers, all that's going to happen is the tax table will change from now, and the tax table changes will reflect this 1,080 or this $2,500, depending on how much your employees are earning, and they'll just get a slightly reduced amount. So for the vast majority of people, they're going to get $20 a week more in their hand for the rest of the financial year. I'm not sure how many people are that excited about that, but that's all that personal tax cut is. Does that all make sense? Everybody understand all that? We follow that? So what I wanted to do then was focus on the changes that they've made to business. And the centerpiece of their change to business is to try and get businesses to buy stuff that's depreciable. So the biggest single change is this asset write-off. Now, a lot of you will be familiar with the fact that over the last 6 months or so, since we've had the COVID virus with us, the government introduced a $150,000 instant asset write-off. And we've had a lot of clients trying to buy commercial vehicles and all sorts of other things, and to try and get an instant deduction for that $150,000. But what happened in the budget is the government has decided to put that instant asset write-off on steroids. So if your business is turning under $5 billion a year, which I'm going to assume is most of us that are on this conference call, if you buy an asset that is installed for use or used by the 30th of June 22, so anytime over basically the next 2 years, you're going to be able to instantly write off 100% of that asset in the year in which you first used it. And if you're a business that turns over under $50 million, if you're a business that turns over more than $50 million, it only applies to new assets. But other than that, there is no restriction. So if you were what was the example we discussed earlier, Stu? There was you mentioned a particular type of
just a couple of civil groups of ours and mining services.
Yeah. So if you went out, I mean, I've got an example here, which will just give you an idea of how this would work in practice. So if we have a look at this particular example here, we've got a business that we've called Bogong Builders. They're turning over 60 million a year. On the 1st of July 21, so it doesn't really matter when, but before the 30th of June 22, they've gone out and bought a concrete pump for $1 million. Now, the way this example works is it says for that particular financial year, their income was tracking at a profit of about 600,000. Ordinarily, with that concrete pump, they would have depreciated over the life of the pump, and they might have got, in this example that we're saying, they would have got a deduction of 300,000. So they would have ended up with taxable income of 300,000, and at a 30% company tax rate, that results in 90,000 of tax payable. Under this new measure, the way that works is that they just deduct the whole million. So substituting the 300,000 here, we just write the whole million off as a deduction in 1 year. And that results, instead of a profit, that results in a $400,000 loss, and tax becomes zero. So you can see that the attraction here is if you're a business that is spending reasonably large amounts of money on depreciable items, and if you're in trucking or mining or any of those services where you're buying large plant that you would normally depreciate over 3, 4, 5 years, whatever the case might be, there's now going to be the ability to create very large write-offs and reduce your profits in those years for tax purposes to nil. Now, there is a second part of this that I want to tie in, and then we can talk more generally about how this might work. So the second part of this is the government has announced this asset write-off. I want you to keep in mind Bogong's $400,000 loss that they've created by writing off that pump that they bought. What the government's also brought in, and they did this, some of you might remember this, I suspect not, because there's only really tax nerds that remember this, but back in 2013, they brought in this thing called loss carryback. So most of us would be familiar with the idea that we can make a tax loss and we can carry that forward to use against future profits. A loss carryback is just the same thing in reverse. So you'll see in this example, we've got a client who in the 2019 year, you've made a profit and you've paid tax. And then in the 20 year, the 21 year and the 22 year, you're making losses. What this provision will allow is you can take a loss. So if we look at Bogong Building, in 22 with that pump they bought, they've made a $400,000 loss. They will now be able to take that loss back to any of these earlier years where they've made a profit, starting at the 19 year. And they'll be able to basically claim the tax they've paid back in that year. So assuming in the profit year they've made more than 400,000 and their tax rate was 30%, so they've paid 120K of tax, they'll be able to lodge their 22 return and get that 120K that they paid 3 years earlier, get that back as a cash refund. There are some restrictions around that. You've got to have enough franking account balances. I don't want to get into too many nerdy tax topics, but hopefully Stu and Josh and the others joining us will know what I mean by that. You've just got to make sure you don't have a franking deficit. But generally what it means is if you're a business out there, you've had a good 19, you've had a decent 20, and you're tracking along all right, and you're looking like you might make a profit, say in 21, but you've been thinking about buying, 5 trucks that's going to cost you, $1 million, create a loss in the 21 year by a genuine, useful capital investment, and then go back and apply that loss against those profit years and get some of your tax back. So I would have thought that's attractive for some clients. Would we agree, guys? Other people watching me there? I would have thought. Now, there is some tax planning we need to do around that and just make sure it all works for you. But as a general rule, that's what the government's trying to do, is encourage businesses that are thinking about investing in depreciating items to do it, because you're going to get an instant asset deduction for doing it. And then the double whammy is if you manage to create a loss, or if you actually have a loss, you're then potentially going to be able to go back and get some of the tax you've paid 19, 20, or whenever it happens to be, and get some of that tax back. Is there any questions at all on that?
Yeah, Andrew, we had a couple of questions just earlier in the week on the types of assets that may apply to. So, for instance, would it apply to a fit out, or would it apply to a shed?
So it will apply generally to any items that are normal depreciating items. So if they're included via a special depreciation provision, for example, anything that's deductible under the building depreciation rules, that wouldn't be included. So with a fit out, it would depend on whether that became part of the building and was covered by building depreciation, or whether it was just a normal depreciating item. What I'm trying to do is argue that the things that have been fitted are technically removable, so that we're able to claim a deduction for them over time. In those cases, perhaps we could get a deduction for that. It's just a matter, there is a list of excluded items, but they're essentially those unusual depreciation sections like building depreciation, where it's a specific criteria that gets them in. There is no upper limit here either. So one of the things that comes in with this is that for clients who have, for example, low value pools or SBE pools, those pool balances are all going to be written off. And I was talking to some people earlier today, and they've got a boat sitting in a pool because they run a boat charter business. And that boat is sitting there in the pool with the pool. It's the only thing in the pool, but it's sitting there with an unwritten down value of almost $5 million. And it appears under these measures that in the 21 year, you'll just write that balance off. So they immediately get a $5 million deduction, which obviously would be relatively attractive to someone in that sort of business.
Yep. The luxury car limit also applies, so that's something to think about. But this really can allow us all to do some really good tax planning and be very beneficial for some of our clients. There must be something wrong with the internet.
Right.
It doesn't matter.
Yeah. There's something wrong with the internet. And is it my end or your end? So I'm occasionally, that's cracking up at your end. I'm trying to fix it. Can you still hear me, all of you? Just give me the thumbs up. Yep. Okay. Thanks, guys. I didn't. Yeah. Sorry about that, Leanne. I didn't quite hear that. But as you can see, any businesses, it does create. Look, from a tax accountant's point of view, it does create some interesting outcomes. You're potentially going to have a situation where a client who's trading through a trust. We're potentially going to have a large loss created by depreciation, and as people would be aware, losses in trusts can be a bit of an issue. They can create various other potential issues. So there are a series of management issues that we need to put around this. But as a general concept, it's pretty concessional from the government. And as I say, it's businesses all the way up to $5 billion. So it's businesses all the way up to that. Now, unfortunately, Matthew, in response to your question, yes, the luxury car limit and the car depreciation limits are still in place. So if it's a motor vehicle, you're only going to get the 57 grand. I was already asked this morning, and I'm presuming it was by someone who was being mischievous, whether he could get his Lamborghini SUV as a deduction under this. Unfortunately, that would be a car, and it would be limited to 57 grand. I do like the thinking, but I'm pretty sure that's not where the government wants us to go. Unless you could argue that Lamborghini was some sort of one-ton ute, which seems unlikely. So, just be aware. Yeah, so that's just come up. So I've got two queries on that. So there is, with respect to cars, we do still have the 57. I think it's actually for the current year, it's been indexed up to about 59 grand for cars. But yeah, that's essentially the issue. So other than that, though, your general depreciating items in mining services, trucking, areas where people are spending really large amounts on things that are just normally depreciated, instant deduction. Now, that does also create an issue down the other side. We've seen this in the past when they had investment allowances many years ago in areas like primary production, where people would go out and buy a header for 600 grand. They'd climb an outright deduction for that. And then 5 years later, they'd sell it for 500. Issues that we do need to manage from a tax accounting point of view, but it is a concession and it is quite a generous one. Okay, I'll move on from there. This is a minor one, but it might have impact for some of you. There has always been, for small business entities turning over less than 10 million, a series of small business tax concessions. And the government has decided to extend not all of those, but 10 of them, from businesses turning over less than 10 million to businesses turning over less than 50 million. And some of these are pretty non-exciting, but a couple of them might have some value. So one of them is car parking fringe benefits. And I don't know how many people we have that have that, but if you're providing car parking for your employees, obviously there's potential for fringe benefits tax on that. There's always been an exclusion if you're a business turning over less than 10 million. That's now increased, or with effect from next year, that's increased to 50 million. So we'd need to look through it and see whether there's any benefits. Then certainly one of the benefits here is prepayments. So there's been for a number of years a prepayments provision in the Act that allows for a deduction for certain prepaid expenses paid up to 12 months in advance for small business entities. That has now been extended to businesses turning up to 50 million. So there is some potential planning opportunities there where people perhaps in the 2021 financial year, when we get to June, we could prepay some expenses and bring those deductions forward. So there's a few things in there. There's another couple of little FBT changes. And there's also, and I'm not going to get too excited about this because the guys will tell you that this is a bit meaningless, but the government has also decided to to reduce from a 4-year amendment period to a 2-year amendment period, not just for businesses turning less than 10 million, but also 50 million, which theoretically sounds great that the ATO can only audit your return for a maximum of 2 years past. But as Stu and I'm sure the others will tell you, the ATO has an ability to extend that back out to 4 years if they consider that your affairs are complex. And our experience is that if the ATO wants to, they just say your affairs are complex and add 2 more years. Is that fair, guys? Is that a fair representation of what they do? I think that's true. So there are some more concessions in there that may have some value, but obviously the guys at Shakes will go through and see whether those have application for you. The other one that has copped a fair bit of attention, quite a bit of it negative, it must be said, on Talkback Radio over the last couple of days since the budget was handed down, is JobMaker. My negative about it is that they've called it JobMaker so that we now have JobSeeker, JobKeeper and JobMaker, which just gets confusing. But the concept here is to give a wage subsidy effectively to employers who hire new employees who are under the age of 35. Now, there is some rules around that. Now, the Talkback Radio stuff has all you employers out there will fire all your existing employees and hire new ones who are under the age of 35 because you're going to get up to $200 a week in subsidy from the government for a year. But there are rules to try and stop you doing that. Those rules are that you need to be able to demonstrate that your headcount has gone up and that your payroll has gone up for each new position created. So in very, very simple terms, the government benchmarks this at the 30th of September and they say on that date, what was your employee headcount? And let's say it was 25. In order to qualify this, your headcount would have to go up. So if you hire someone, if you sack 10 people, the first 10 new people that you hire, you're not going to get this credit for anyway. So there's no point doing that. But if you added 2 new people, so you go to 27, and if as a result your payroll goes up, if those people are under the age of 30, so they're 16 to 29, and they have received JobSeeker or youth allowance during the previous 3 months, then you'll be able to get $200 a week from the government paid as a subsidy for their salary for up to 12 months. Now that subsidy is paid quarterly in arrears, and those people have to work for 20 plus hours per week. But it means you can hire somebody who has been on JobSeeker. They're 20 years old, say, you hire them, you put them on 20 hours a week work. So I don't know what their wage rate is, but let's say it's $20 an hour. So they would normally be getting $400 a week from you. You're going to get $200 of that back from the government at the end of each quarter for the first 12 months of their employment, which is obviously reasonably concessional. If you're in a business that, we've all seen clients running hospitality and other businesses where maybe we could take on one more service staff member during peak times, but we're not quite sure. Well, this might give you the cost relief to look at doing that. There is also an amount that you get for people who are aged 30 to 35. The amount you get there, though, is $100 a week as opposed to $200 a week. But that's for any position. as long as those people have been on job seeker or youth allowance for some period during the previous, at this stage it says the previous 3 months, and as long as they're between the ages of 16 and 35. Okay. Any questions on that? Everyone understands that. I've heard people calling in to talk about. One guy called in and said, I've been out of the workforce for 2 years, finishing my master's, and I'm 42, and as a result of this, no one's going to hire me. My view is that if you're 42, you've got 20 years work experience and a master's, and you can't get a job because a 20-year-old kid off Centrelink getting a small subsidy keeps you out, you probably did the wrong master's. But that's just me. And I'm sometimes mean, so maybe that's just me being mean. So any questions at all on that, I'm happy to take them. There is also, this looks a lot like the subsidy, and I think Aidan, we did a bit of work on this earlier this year. They've had a subsidy in place for apprentices and trainees during this year. This is a new program starting on the 1st of January 21, but it looks quite similar to the old program. So I presume it's the old program rehashed and run for another year. Have you looked at that yet? I'm looking at you looking puzzled. Sorry if I've dropped you in that there, but essentially what this is a new subsidy for up to 100,000 new apprentices and trainees. And what you're going to get for those apprentices and trainees is a 50% subsidy on their wages, up to a maximum of $7,000 per quarter. Quarterly in arrears, just pay from the 1st of January, but obviously will likely be later than that. So, I mean, it's quite a significant subsidy. My understanding is, and Aidan, you can jump in anywhere here because you probably, my understanding is these apprenticeships and trainees are all run through they're administered by a traineeship area or section, is that right?
Yeah, so there's
I'm looking.
a few steps that have to be taken. So it's a little bit different to the last one, but it's an apprentice or a trainee, essentially someone studying, I think it's a level 2 or above at TAFE, and then you can register them under the program and get reimbursed 50%. So there are restrictions on what type of traineeships can fall under it, but pretty much all apprenticeships qualify for it.
Okay. Cool. So, yeah, that's another pool of money that's out there that the government estimates is going to cost them $1.2 billion over the year. So it's certainly something worth looking at for anyone who's got those apprentices or trainees. Josh, did you want to say something there? No?
Yeah, like you mentioned before, mate, it's done through your registered training organisation as well. So it's not done through the tax office. So you have to go through who you're registered with or the organisation you're registered with, as you mentioned before.
And they pretty much do everything for you, don't they? From my memory of the one last time. I mean, the employer almost gets the money by default.
Yeah, that's what happened in practice the first round with, I believe there's 3 or 4 in WA. 3 or 2 did it automatically and 1 you had to chase up. But yeah, so it does depend.
Okay, no worries. Okay, the next area I wanted to go to was some changes to lending. So the government has made, and I'll get Stu involved in the next slide, I think on this one. The government has been concerned throughout probably the last year, but certainly since COVID hit, that it's increasingly difficult to borrow money from banks, and that problem is exacerbated even more for small and medium business who have found it very, very difficult. So when COVID, they announced a government-backed lending program. We'll look at that on the next slide, but I just want to look at a much bigger step that they've taken to try and increase or make easier the flow of money from lenders to borrowers. And this has obviously copped a bit of press over the last week or so since they announced it. They intend to remove the responsible lending rules from the National Consumer Credit Protection Act. Now, these were introduced in 2009 after the GFC, which, as I'm sure everyone's aware, was largely blamed, or large slabs of that were blamed on the banks profligate lending policies. And I'm sure some of us attending this remember the days where we'd get random letters from banks saying we'd been pre-approved for $100,000 credit cards that we didn't need and all sorts of other things like that. They were pretty easy days. Now, the problem is that with most people see this primarily when they're applying for housing loans, but the responsible lending rules push the responsibility for lending or borrowing onto the lender, so that if they lend you money and they should have known that you weren't capable of repaying it, you can effectively walk away from the debt and say that it's their fault. They shouldn't have lent it to me. So that's made the banks increasingly tight in their conditions for lending. And anyone who's applied for a housing loan and had to have a discussion with their lender about why they have both a Netflix and a Stan subscription instead of just one, and why they're wasting $12 a month on a streaming service or spending $1,000 on Uber Eats, probably understands that at the moment it's a little bit invasive and it's a little bit hard to get money from those banks. Now that is even worse at the small business lending point, unless you have at all going to make it for lend, can now lend to borrowers. Business shifts back to us as lend. Hopefully what that will do is make the banks a little bit more willing to lend. And they've also making some changes to consumer lending laws as it applies to small business lending specifically. So they're trying to make it easier to lend money and borrow money if you're a business. Now, tied into that is the SME loan guarantee scheme that they announced earlier this year, but which in the lead up to the budget and again re-announced in the budget, they've expanded. So the government announced when COVID broke out that they were going to provide $40 billion to give a 50% guarantee on loans to SMEs. Now, these loans initially were for a maximum amount of $250, and the other 50% that wasn't guaranteed by the government had to be unsecured. Unsurprisingly, the banks haven't really bought into these loans much, and the money's still sitting there. So the government has decided to revamp that scheme. They've now increased the maximum amount of the loan to $1 million, the maximum term to 5 years. The loans are 50% guaranteed by the government, but they're now going to allow some component of the loan to be secured. And Stu, I think we had a discussion yesterday where they're probably going to allow those loans for certain commercial property purchases. Is that correct?
That's right, yeah. I mean, it's pretty far-reaching what they can be used for as the update the government's provided. There's a few assets that can't, and they're largely residential property. You can't use the products for financial products. They can't be lent, and they can't be used to refinance equipment or assets that have been advertised more than halfway through their effective life. But we think this one particularly could have some pretty positive benefits for any clients that are looking to lend and may have had some property value issues that may be impacting their LVRs and those sorts of things. So something to keep in mind anyway.
And it's quite a large amount of money. And if you then overlaid in the early part of next year, because that scheme at this stage runs till June next year, if they were able to get these changes through to the lending criteria as well from the bank's point of view, a large pot of money and easier lending criteria would potentially free up a lot of available funds for people in business to borrow. So it is going to be interesting over the next several months how much they are able to free up in that space, because it will make there'll be a lot of opportunities out there. So if there's some finance out there, it'll be interesting to see how that plays out. So on the opposite side of this sector, and I'm just going to mention this quickly so that I can say that I've mentioned it. We don't have to go into it in enormous detail, but the The government has also announced something that has been bubbling away in the background for a while, and it's a small business debt restructure arrangement that allows businesses that are in trouble, that have debts of up to $1 million, to effectively restructure those debts without having to appoint an administrator. So this would allow them to use things called small business credit as that. You would then be able to say, okay, I can't afford my debts. I've got the creditors are after me. You can then have 20 days, which is a month, 20 business days, to develop a restructuring plan, which you then put to your creditors, and your creditors will vote on that within 3 weeks, within 15 days. So you basically get a 6 to 7 week period to restructure your debt, get your creditors to agree to that, but all the way through that, you are in control of your business. You haven't had to appoint an administrator, and you get to continue to operate your business. This is like a watered down version of the US's Chapter 11 bankruptcy, where businesses can just throw their hands up and say, the business is fine, but the debt's killing us. We need some time to restructure the debt. It does pose some risks to unsecured creditors, because in a vote, if they're relatively small unsecured creditors, the bank will probably get looked after, but the unsecured creditors on a restructure probably won't. That's usually what happens in the US. But it is an option. It will apply from 1 January next year. Obviously, it's something that we as accountants need to be across, but it is something for businesses as an alternative to going into administration. So I'll move on. The budget and the commentary around the budget have decried the death of the employer default superannuation. And I just wanted to mention this because obviously a lot of the people attending this will be employees or employers. What the government is proposing is from 1 July next year, employers will not create new accounts for super. So whilst people have had choice of super in a lot of industries for a lot of years, most employers still have a default superannuation account. And that default superannuation account often ends up having a lot of the employees in it because people haven't made their own choice and don't know what to do, so they're happy to go with the default one. What's going to happen from 1 July is people are going to have a My Super or a Your Super account that's a lot like MyGov. So you will go into your My Super account, you'll set up your choice of super independently of your employer, and that choice of super will follow you wherever you go. And from the 1st of July, fully automated by the 1st of July 22, when a new employee starts, you will put their payroll information into your single touch payroll system, and it will pre-fill with their superannuation based on what's in their My Super account. Hopefully that makes sense. So basically the employer will effectively be removed from that superannuation selection. Not yet, not till 1 July 21, but it is coming. Okay. And that's just another account that we're going to all have. MyGov, My Super, My whatever, all government ones that are interacting with single touch payroll. Now, the only other thing I've mentioned on here, I've just put it on one slide just as a whole batch of things, is the government has made a lot of noise over the last little while about manufacturing and manufacturing incentives. And in particular in certain areas. So they saw when COVID came out that the government was concerned masks and so on were not manufactured in Australia, and we were dependent on other countries for that. And in a crisis, other countries tend to look after themselves before they look after us. So there became greater concerns about the supply chain in medical areas and various other areas. So the government is targeting large pools of money in various sectors to try and assist in product creation and business upscaling. Not limited to those areas, but certainly there is a targeting of areas where maybe they would prefer the supply chain be based in Australia. Did anyone, I don't know if any of you guys have read into those for particular client areas you've looked at? No, I'm getting shakes of the head, so I'm assuming no. But there are some large pools of money out there. And obviously on an industry by industry basis or a client by client basis, we can go through those and have a look at what might be available. That was really all I wanted to go through of the sort of the big picture items that were in the budget. Did you guys have any questions for me, or did anyone else have any questions for me? Silence. I was going to put this slide up, but you're not on it, Leanne. So that seems, I'm not sure. Perhaps there wasn't space, or perhaps we wanted to just go with guys in sort of grey suits. I'm not quite sure how that worked, but those are the contact details of the other erstwhile attendees. But I'm sure Leanne is quite happy to talk to you all as well, even though she apparently doesn't warrant a photo on my slide. So apologies for that. I hope you're not upset.
I'm definitely not upset. Everyone knows where to find me.
So obviously, if you want to talk to anyone or contact anyone, that's those contact information details are there. There may be some industry specific stuff that you've got that might fall under these criteria. But other than that, as I say, it's the instant asset write-off, the loss carryback, some of those lending rules, and the job maker stuff for those of you that might be currently looking at hiring some new employees. Just making sure that you've looked through that job maker stuff to see if it does apply to you. Because, you know, if you're taking on 3 staff and you can get $200 a week of that subsidised by the government, for example, you know, 10 grand a year for that first year, 30 grand, that's a whole other employee in and of themselves. So it's certainly worth working through that to make sure you're eligible. Other than that, that's all I wanted to say. I'll hand it back to Stu. Whether he likes it.
Thanks, Andrew. Much appreciated. Leanne, Josh, and Aidan, anything you wanted to add there at all? No.
We're available if anyone's got any questions about specifics, and also we'll definitely be looking at some planning opportunities moving forward.
Yes, there's certainly something. Yep.
Well said, Leanne. I guess in finishing off, guys, thanks for checking in. I mean, from a summarising point of view, from our viewpoint, the tax cuts were probably on the smaller side of what we maybe thought could have happened, but every little bit does help. So they were positive. The asset write-off, as Leanne mentioned, particularly when you link them in with those loss-back measures, they can be quite a powerful planning mechanism. So we'll be looking through those and how we can apply them, because we're pretty confident we can get some pretty substantial and material wins with those measures. And then the lending one, it's really significant. The 50% government secured means that in combination with your own funds, we can actually achieve outcomes to acquire assets or business related things that maybe you couldn't before. So keep all that in mind, and probably would like you to take them as the key takeouts. And we're here, like Leanne said, and please thanks again for checking in. Cheers.
Thanks, guys, and apologies for my technical issues. Cheers.
Thanks, everyone.
Thanks, everyone.
Have a good day. Bye.
Cheers. Thank you. I don't know how to stop this.